One particular stock in focus from the banking space, City Union Bank, is down around 6% at this point in time. After reporting its Q1 numbers, the business momentum was weak this quarter. There was a sharp worsening which has taken place in the asset quality as well. We have with us Mr. N Kamakodi, who's the MD and CEO of City Union Bank, who's joining in. Mr. Kamakodi, welcome to the show. Well, there are a lot of questions to discuss with you with regards to the Q1 performance. But let's start with the loan growth, which has slowed down all the way to around 3.6% versus 6.7% in Q4 and versus around 12% in Q3, 10% in Q2, 12% in Q1 of FY23. So there's been a significant slowdown which has taken place in your advances this quarter. What led to that?
Normally, we have, some amount of negative figure for the first quarter, and which is there. But overall, there are a couple of things like when you compare ourselves with our peers who have double-digit business growth, our focus had been purely on the MSME, trading and agriculture, while the bulk of the growth for others have come from the retail and housing loan and other consumption loan, in which we don't have a significant presence. In regarding the MSME sector, we could see a pattern where the CC limit utilization, which normally used to be about 80%, as currently it stands about 70%, and now only we are seeing some amount of improvement, at least in the discussion stage for the capital investment and investment cycle to start with on the MSME sector. And number two, we had clearly discussed about this along with our last quarter results. So we expect a bulk of the growth to happen only in the second half, and we are currently in the process of making our digital lending processes to improve our lending processes and all, which is underway. So by the year end, we expect we should be having a double-digit growth rate, bulk of it coming from our existing loan mix of the MSME, commercial trading and agriculture is where we are in currently.
All right, double-digit growth rate is what you're factoring in, most of that coming in the second half of this year itself. The industry will hold you on to that, because that will again then be in line with the industry itself, not growing faster. Just wanted to understand your thoughts on the slippages. You said you are focusing on MSMEs, but a large part of your slippages came in from MSMEs itself. What are your thoughts on asset quality going ahead, credit cost, and what kind of slippages are you factoring in this year?
Yeah, if you had seen our pattern, we typically used to have about, for 5 years during pre-COVID, 2 to 2.5% annual slippage to closing advances, which increased to about 3 to 3.5% for the last 3 years during the COVID. And this year, we see that moderating. In fact, we had about around 1,300 crore last year slippage. This year, we expect at least to get it better, to have it between 850 to 1,000 crore, which means that we will be having about 250 odd crore about incremental benefit because of the slippage. So we expect the both the slippage and also the net NPA figures to come to the pre-COVID level by the end of the current year is what we are expecting at this point of time. The incremental slippage ratio, we are able to see visibility on things getting moderated now.
Okay, so when you mean back to pre-COVID levels in terms of net NPA, it will be less than 2% by end of FY24? Okay.
Yes.
So when you spoke about the growth coming in from existing segments right now, are you focusing on the newer segments as well, something that your peers are functioning in, and what would that be as a part of the book?
We have already initiated steps to build those skill sets and capacity on growth through the consumption segment, like housing loan and all, and other retail segments. They will form the growth engine for the future. Maybe if you take a 3 to 4 year or 3 to 5 year time frame, the incremental business from that should be about around not less than 5% or so in overall metrics when we go over there.
Okay. Mr. Kamakodi, can you just give us more details about this committee which is formed with regards to succession planning? We do understand that your tenure ends in 2026, which is end of April for that fiscal. But the succession planning is starting now. Can you just give us more details in terms of when we could probably hear a successor?
See, what we expect is that at least, like say, we would like to have the potential successor working with the current team so that there is a proper, like say, alignment in terms of smoother succession when the time actually ends. So if it is April 2026, you at least need not less than 6 months prior to that, you need to apply for the regulatory approvals and like that. So you need at least another 1.5 years to have a commonality. So we expect something to be concrete, like say, by the end or by the beginning of the next financial year, at least 6 months to 1 year time frame is to identify and shortlist. After that, parallel working and other regulatory processes will start.
And you are looking at a successor from inside the bank itself, or are external candidates being looking at as well?
Both options, the evaluations will be there.
Okay. All right, Mr. Kamakodi, thank you so much for joining us today and detailing all the numbers and telling us what the plans are going ahead as well. Well, on that